Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights US Presidential Election Special Edition. So, as usual, before we start our daily dose, very good morning to all. Today will be Friday, the 1st of November 2024. And let's have a quick look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we start today's daily dose of the usual intraday short-term technical outlook, we tend to actually have a brief recap of what has taken shape yesterday. And do not forget, yesterday we do have a public holiday, though there is some much ground to cover on 2 days of event, which is very important. I want to share with you all because it actually changed the short-term dynamics of the intraday technical outlook chart on those usual broad-based cross-asset classes that we cover as well. And we also, because this is a run up to ahead of next week, 5th of November, i.e. Singapore time will be 6th of November, the results of the US presidential election. So I want to share with you some insights pertaining to this US presidential election that could impact the movement of the broad-based cross-asset classes as we head into the 5th of November. Singapore time will be 6th of November polling day, and as well as on the 6th of November, early Singapore time at around 8 a.m. to 9 a.m., we'll see some of the United States states releasing some of their results. All right, so it could have some impact on the broad-based cross-asset classes as well. So let's kickstart on what has taken shape yesterday. So let me touch on firstly on the movement of the broad-based cross-asset classes in terms of the major US stock indices. All right, so let us start with the movement of the US stock indices first. So what you could see the last 2 days is across the board risk-off environment. But for those who follow our daily dose of market insights since late last week, I do highlight that there is some intermarket dynamics and that could potentially see some weakness on the Nasdaq 100 due to the rising 10-year US Treasury yield, and the last 2 days of price action on the Nasdaq 100 indeed validated that. All right, so what we could see over here is that both the SPX and the Nasdaq 100 actually went down the most yesterday, down negative 1.86%, and the Nasdaq 100 was down negative 2.44%. But however, the steepness of the negative feedback loop in the Nasdaq 100 tends to actually eradicate the earlier so-called anticipated outperformance of the Dow Jones and the Russell 2000. Yes, they do outperform the Nasdaq 100, but however, they outperform on the negative side of the story because they failed to actually maintain the so-called Trump trade positive momentum that technically should be impacted on the Dow Jones and the Russell 2000, given that Trump is still leading the betting odds comfortably by above the 60% odds. Later I'll touch more about that. All right, so the Dow Jones is down slightly, negative, not down slightly, they're still down, but their losses has a lower magnitude as compared to the Nasdaq 100, which is down by 2.44% yesterday. So the Dow Jones is down negative 0.9%, the Russell 2000 down negative 1.63%. But however, the movement of the 2 days of movement on these 4 major US stock indices, particularly on the Nasdaq 100 and the SPX, because they are heavily weighted by mega cap technology stocks, and we know that this mega cap technology stock has a very huge following in terms of fund flows flowing into this AI optimism play. So further weakness on the Nasdaq 100 and the SPX could actually potential kickstart a negative feedback loop into the entire US stock market, and also has some form of impact globally as well, given that most of the global market participants tends to have a huge concentrated weightage in their portfolio towards this AI team play, optimism play, and those are heavily skewed towards those heavy weighted mega cap technology stock listed on the US stock exchange. So with that, let me share with you the end of month price action on these four major stock indices, starting with the Nasdaq 100 first. So you could see over here is that the monthly performance of the Nasdaq 100 is not so rosy. So it ended the month of October in the red, that means with a black candlestick, down negative 0.85%, but it starts to form this very bearish dragonfly gravestone doji candlestick on a monthly basis. And if you were to look at the SPX 500 as well, this will be a shooting star over here, and that impacted the Dow Jones as well, forming this shooting star candlestick at the top of this major ascending channel since the low of October 2022, and as well as the Russell 2000. Okay, also this shooting star, okay, a bearish shooting star as well. So net overall, what we could see over here is that the sell off, the much more we call it steeper pace of sell off in the last 2 days on the Nasdaq 100, driven by the negativeness seen, the negative price action seen in the mega cap technology stocks, that means the likes of Apple, Meta, Amazon, Alphabet, in line with the risk event this week, which was the release of all their earnings, quarterly earnings. At the end of the month, they actually ended with monthly bearish candlestick formation that causes a negative feedback loop into the other major stock indices as well, like the Russell 2000 and the Dow Jones. That means going forward, as we head into the US presidential election polling day, which is 5th of November, 5th of November US time, Singapore time will be 6th of November. Potentially there could be much more two-way high volatility movement on the intraday basis. But overall, this monthly candlestick potentially could start to kickstart a multi-week corrective decline on the major US stock indices. That's what I want to share with you all on the price action movement in relationship with the news flow that has taken shape on the major US stock indices 2 days ago. And because of also being reinforced by what I call very weak guardians in two of the we call it mega cap technology stock, which is Microsoft and Meta. So Meta, yes, their earnings beat, but it warns that worsening AI losses after sales narrowly beat. All right, so it gives a rather lackluster guidance pertaining to the AI related business. Similar for Microsoft as well over here. Let it run for a while. So Microsoft gave a yes, Microsoft beat over here in terms of iPhone, in front of what I call the overall earnings, but their cloud division, which is one of the crown jewel of their overall revenue pie, has a significant impact on it, a crown jewel, but it gives us lackluster growth forecast, disappointing crowd growth forecast that also put a drag on Microsoft stock price as well. Okay, despite the fact that Microsoft overall revenue and earnings managed to beat expectation. And what we have is Apple earlier this morning, Asia session time about 4:30 a.m. Singapore time, due to the fact that also Apple issue lackluster forecast as well as China, which of it, their sales revenue also weakened. All right, so the only one that see a rising, we call it revenue beat, earnings beat will be Amazon over here. All right, so the AWS sales unit rose 19%. So Amazon, the only stock that managed to actually rose after the earnings announcement. So if I'm speaking right now, actually Amazon AMZE, the share price, okay, it actually rose by 6% in after hours, okay, after declining 3% yesterday. But net overall, later I'll share with the short-term technical outlook on the Nasdaq 100. Despite the fact that even though Amazon managed to see a big push up in the after hours trading, it didn't actually causes the Nasdaq 100 ETF, the Nasdaq 100 CFD index, where we actually take from the E-mini futures price action to shape any significant push up. All right, so later I'll share more on the short-term technical outlook on the Nasdaq 100 CFD price action based on OANDA's CFD index. All right, then the next news flow I want to share with you yesterday is more pertaining to the Bank of Japan. So Bank of Japan yesterday made their interest rate decision, but came in within market expectation. No interest rate hike stampede, and also they didn't actually change much of their we call it long-term inflationary trend forecast and growth forecast in the latest quarterly outlook report that was also released yesterday. But what's interesting is after or during the press conference at Singapore time around 1 p.m., where BOJ Governor Yuda speak with the press, and he did highlight over here is that BOJ is still on track for more rate hikes after yesterday's hold. All right, so he kind of brushed off with the current political uncertainty that is surrounding the we call it the leadership of LDP. So we know that this last the last Sunday snap general election, LDP and its current coalition commando didn't actually manage to hold on to the 233 seats required to form a majority sitting in the lower house. And due to this fact that LDP may be forced to embrace more pro-growth policy, which potentially could add pressure to Bank of Japan to slow down their gradual interest rate hike that Yuda has started to advocate since start of this year. But yesterday during the press conference, Yuda tried to play down this fact and maintains Bank of Japan independent stance over here, that's saying that they are more looking in line with clear fundamental mandate or fundamental data or economic data, and as well as external data out from US, especially risk coming out from the US presidential election, that will actually dictate their monetary policy stances going forward. So with this kind of what I call independence stance that Yuda tends to lay out yesterday in yesterday's press conference, neglecting whatever happened internally with LDP and their political, we call it struggles, as they try to form more alliances to have that 233 seats. The yen actually strengthened yesterday against the dollar and broke down that 152.50 key support with the dollar yen. So later I'll share with you all, the yen could be paused for more kind of strengthening, at least from a near-term perspective, because some technical configuration actually supports this particular scenario when I covered on the short-term intraday technical outlook chart on the dollar yen. That means potential yen strength coming back into the FX market, at least on a near-term basis. Okay, then another news flow I'll share with you all is more pertaining to oil price. So we know that oil price has been trapped inside a big side range, can't break down below $65 per barrel, which is based on the price action of West Texas crude oil. Above it, it can't break above $73 per barrel. And yesterday, 2 days ago, oil price managed to actually spike up. All right, so we turned neutral before the Deepavali break because of that mixed element on the short-term technical outlook chart, the hourly chart of West Texas crude oil. And during yesterday, there was actually this sources reported by Reuters. So sources that is close to OPEC Plus members potentially say that due to the recent weakness on oil price, where oil price starts to tumble down at the start of this week. So on Monday, it gapped down due to the lesser geopolitical risk premium because Israel did not attack Iran so harshly, and they didn't attack on Iran's oil producing facility. That causes the oil price to gap down by 6% to 5% on Monday. All right. Then when that happened on Wednesday, oil prices continues to languish or trade very softly around that $65 per barrel on West Texas crude oil. Then there came this particular Reuters news flow reporting that OPEC Plus sources saying that they could delay December planned oil output hike. Still recall that in the last OPEC Plus meeting, OPEC Plus wanted to solely normalize their so-called previous hike plans by solely releasing more oil supply into the market. But given this oil weakness that was seen this week, I believe that OPEC Plus want to gut their revenue, so they came out with this kind of what I call positive news flow that could impact oil prices to allow oil price not to trade below that $65 per barrel. So more or less what we could see over here is that in the next few sessions, especially coming up to the 5th of November US polling day, Singapore 6th of November, oil price could be whipsawing around a very messy, choppy, sideways range configuration. No clear uptrend or downtrend that is to be formed. Okay, so that's for oil price. And also one thing that is more pertaining to the FX market is the weakness on the sterling dollar. Still recall that on the short-term technical outlook on the sterling dollar, we turn neutral before we go for Deepavali break, 130.10, 129.50, and the sterling was the weakest in the last two days. It broke below 129.50. Why? Because of the new UK budget that was announced on Wednesday. This particular budget over here causes the what you call it is regarding the budget worries, causes the sterling dollar to weaken much more significantly in the last 2 days, given that the fact that the new chancellor over here increase, wait, give me a minute, all the way down, let me share your, okay, it's somewhere around, okay, 1 second, let me open up the chart. It should be this level here. Okay, this UK budget. Yes, all right. So the new chancellor Rachel Reeves actually wanted or proposed more extra fiscal spending in UK. So notice that from 2025, 2026, 2027, in the next 5 to 4 years or so, there's a significant increase in fiscal spending over here. That means, i.e., it could actually widen the fiscal, we call it a budget deficit in UK that potentially could be inflationary in nature. And because of this widening of this budget deficit, there is a risk there will be we call it a higher yield that is being impacted on the UK fixed income asset. That means the UK sovereign bond, we call it gilts. And with that of this widening fiscal deficit, that could also be potentially detrimental to the sterling as well, despite the fact that Bank of England may have less chances to actually reduce interest rate, because an increase in fiscal deficit potentially is inflationary in nature in the medium term to long term. But because of the significant increase over here, there could be a potential further lack of attractiveness or lack of demand on UK sovereign bond, and that could potentially see also a negative impact on the sterling dollar that was being expressed in the last 2 days, where it broke below the neutrality limit of the 1.2950. So later I'll touch on what are the key levels to look out for today on the sterling dollar when we cover on the short-term intraday technical outlook chart. Right. So yeah, that is about the key events that has taken shape yesterday and their impact on the broad-based cross-asset movement. All right. So now let me touch on about more on the US presidential insights over here. So what you could see over here is that the poly market continues to show some which the betting market that market participants from the financial market is paying close attention to. The election forecast so far right now is showing that Trump is still leading comfortably. Yesterday, he dropped by 0.1% point, okay, but still above the 60% mark or 60% odds probability. So 63% odds that Trump is likely to win the White House, whereas Harris is holding to 37. All right, yesterday it went up slightly, all right, but still rather low. It's still below 40%. And if you were to look at the balance of power over here, in terms of the Senate, the betting market is looking at a Republican sweep of 83% odds. And now even the House previously was around 50%. The odds now slightly, previously 2 days ago was around 51, 52. Now slightly the odds shift to the favor of the Republican at 55%. All right. So what we could see over here is that the betting markets in terms of balance of power right now is looking for a higher chance of a Republican sweep, especially in the House. For 51, it actually skewed towards 55, and the White House will be under Trump over here. But if you were to look at the polling markets based on survey, the situation is still neck on neck. This one day data late on 31st of October. Trump is only leading by 48.4% versus Harris 48%. Only a slight chance of 0.4%. So what you could see over here is that there could be a risk that on the actual day itself, on 6th of November, the results are too close to call, right? Too close to call. That means there could be delays to wait for more of the votes counts to come in to finalize who is the winning candidate for the White House. But with that, Trump now has started to stoke up optimism on his supporters. So yesterday he actually insists during one of his rally together with his allies, that means his campaign, we call it supporters, that he has a big lead over Harris, setting stage for a 2024. All right, that means he claimed that he has a big lead over here, and he actually spin up with this scenario of a reality of a sizable lead. Okay, so now the big question over here is that it could actually cause public unrest or stock anger if Harris wins by a coin flip election. That means, i.e., that means on the actual day itself, 6 November Singapore time, things are too close to call. It may wait for a couple of days more to wait for the finalized vote to come in, and Harris may just win marginally, and that could actually lead to so-called public unrest in US, because right now Trump and his campaign supporters are now painting the narrative that he is likely to win by a big margin, based on, I believe that he's looking things at the betting odds, and based on because right now there is some earlier election, the mail-in voting starts to come in, and Trump claimed that based on some of his data sources, some of the swing stage is skewing towards his probability of leading and winning the White House, just based on this mail-in votes, all right, that is coming in earlier. So now the big question over here is that if that doesn't turns up that as what Trump is being expected, and potentially if Harris win by a margin after 1 to 2 days of final vote count, then that could cause public unrest, and potentially that could also see a bit of negative risk off in the stock market. Because of this public unrest, people will start to actually offload this risk of asset, because market will panic at the first sign of such civil unrest, and with the horrors of that previous 4 years ago during the Capitol Hill riot. So people will have that feedback look back into the mindset again. All right, so this is more on the US presidential insights. Now I share with you all. Okay, now with that, let me share with you one intermarket dynamics pertaining to the dollar yen. Okay, so we know that the longer term macro factor that drives the dollar yen is the interest rate differential between the US Treasury yield and the yield on the Japanese government bond, which is the JGB. So let me share with you this particular insights. Okay, where is it? This one. Okay, so what we could see over here is this two graph is the yield spread between the 10-year JGB, 10-year Treasury yield, pardon me, minus of the 10-year JGB yield. So we know that previously, since September, the Treasury yield, the yield spread between the Treasury yield and the 10-year JGB yield has been inching upwards. All right, from as low as 2.73% all the way up to 3.3%. So that actually causes the dollar yen to actually strengthen as well. That means yen weakness against the dollar. And what we could see over here is that it's now coming very close to a resistance level at 3.48. All right, this descending trend line resistance, that is the 10-year spread between the US Treasury and the JGB yield. And at the bottom is much more synchronized with the two respective central bank policy. That means that is the 2-year spread between the US Treasury and the 2-year JGB, the yield spread. And you look at the yield spread right now, it also try to actually inch down from a former support level, now turns into a key intermediate pullback resistance at 3.84%. So given that this two duration of yield spread, the 10-year yield spread between the Treasury, US Treasury and the JGB, and the 2-year yield spread between the US Treasury and JGB are now coming very close to their respective key intermediate resistance level. So that could actually see the 10-year spread and the 2-year spread reverting back to their earlier weakness again. That means the positive yield spread premium will start to actually narrow downwards potentially, okay, based on this intermarket dynamics from this 2-year spread, the 10-year US Treasury spread against the JGB, and the 2-year US Treasury yield spread against the JGB. So that also potentially could start to see why the yen was actually strengthening against the dollar throughout yesterday's session after the Bank of Japan UDA press conference. Right, so later I'll touch more about what are the key levels to look out for when we cover the short-term intraday technical outlook on the dollar yen chart on an hourly basis. All right, so with that, now let us now turn our attention to the individual intraday technical outlook on the broad-based cross asset classes, pardon me, starting with the FX market first. All right, so with the FX market, let us start with the euro dollar. So still recall that the euro dollar, we flipped to a intraday bullish bias before we went to our Deepavali break because there is some form of positiveness that was seen when the price action of euro dollar tumbled downwards right exactly above the 1.0750 short-term pivotal support level. Okay, but before that, let me expand my screen so that you guys could have a better view of the levels. All right, okay, now it's better now. Okay, so with that, price action indeed rallied and it come very close to our resistance level that we highlighted earlier, 1.0890 over here, almost there. So it printed a high yesterday at 1.0880. All right, and what we could see at this point in time, it starts to shape that bearish divergence. Right, there's a bearish divergence on the hourly RSI. That means potentially for today there could be a minor setback on the intraday basis. All right, on the intraday basis, right below 1.0890, which was our resistance that was depicted before the Deepavali break when we flipped to a intraday bullish bias. So with this bearish divergence that's been depicted on the hourly RSI, so for today there'll be a risk of a minor setback. So we will flip to an intraday bearish bias for today using 1.07, pardon me, 1.0915, 1.0915, slightly above 1.0890 as my short-term pivotal resistance level. Flip to an intraday bearish bias for a minor setback scenario. Intraday support level to watch in first step will be the zone at 1.0850 slash 1.0840. So very clearly, this is a previously resistance, something like a mini double bottom, now turned into a pullback support level. Okay, only a breakdown below 1.0840 potentially sees further weakness to at least revisit the minor swing low area of this Wednesday at 1.0808. All right, this level. However, if price action starts to turn up and have an hourly close above 1.0915, then today's intraday bearish bias will be invalidated to see the continuation of the recovery in the euro dollar heading up potentially to expose the next near term resistance level at 1.0955. Above it sees 1.0980 slash 1.0995, which is corresponding very closely to this downward sloping 50-day moving average as well. Okay, in contrast, the sterling dollar is moving on its own right now due to its own internal macro factor that is negative on the sterling dollar due to the higher fiscal spending that is likely to be unleashed in the next 3 or 5 years or so by the latest budget announcement that was done on Wednesday. So with that, it broke down below the 129.50 lower neutrality limit that we set on Wednesday before our Thursday Deepavali break. So using the 1.2950 as my short-term pivotal resistance for today, we will flip to an intraday bearish bias on the sterling dollar. Two key support level to watch again will be at 1.2860. Below it exposes 1.28 figure level, which correspond to the 200-day moving average. Only an hourly close back above 1.2950 potentially sees a mean reversion rebound to revisit the 20-day moving average that is acting as a resistance at 130.15 level. All right, 130.15 level. Above it potentially sees 130.60 next, 130.60 next. Okay, so that's for the sterling dollar. Now, turning our attention will be the Asia Pacific currency, starting with the dollar yen. So like I mentioned earlier, the dollar yen potentially could now start to see further weakness due to that yield spread on the 10-year treasury yield and the against the JGB and the 2-year treasury yield against the JGB potentially see the yield spread premium right now inching downwards. And also in terms of price action, yesterday it formed a Marubozu candlestick over here, a black Marubozu candlestick after 3 consecutive days of small little spinning top, a bit of indecisiveness just right below the 154.70 level. All right, so this 154.70 is rather key. Why? Because this 154.70 previously was supported on 17th of May, 5th of June. Then thereafter, it broke this support. Then there was a retest of it. on the 30th of July, and notice that after that it formed a long shadow, and thereafter you see 1, 2, 3, 4 consecutive days of steep sell-off on the dollar yen, and immediately price action starts to push up over here due to this push up. This push up also done by internal political situation where the uncertainty of the political event that takes shape on the snap general election on Sunday, but can't have a positive breakthrough above 15470, and yesterday it formed a bearish Marubozu candlestick. Also on the background, they also have a key risk event, which is the BOJ interest rate announcement and the BOJ thereafter press conference by Governor Yuda. So given this lackluster price action right below 15470, there could be a chance of at least a form of mean reversion decline to retrace some portion of this multi 4-week of rally that was seen from 16th of September all the way up to 29th of October in the first step. And also the hourly RSI also starts to actually inch downwards from the overbought level, not the hourly, the daily RSI, pardon me. All right, so with that, with this so-called not so bullish rosy element on the daily chart on the dollar yen, so with that I will flip to a intraday bearish bias on the dollar yen on the hourly chart using this 153 figure level as my short-term pivotal resistance level for today. So that was the rejection that was seen at the start of yesterday US session before it printed a series of lower low. All right, and if we would do that Fibo retracement over here, okay, from the high of this Tuesday all the way down to yesterday low, that also corresponds to the golden ratio of 61.8%. So using 153 figure level as my short-term pivotal resistance on the dollar yen, I will flip to a intraday bearish bias. First support level to watch out for will be 155.55 for today. Also pretty key. Why? Because that also corresponds to the longer term 200-day moving average. A breakdown below 151.55 exposes the next near term support at 150.60/30 next, which corresponds to the rising 20-day moving average. However, if price action managed to actually have an hourly close above 153 figure level, then we will have a push up to revisit 153.80 again. Only above 153.80 potentially sees a test at the key resistance of 154.70/80, which I depicted earlier on the daily time frame chart. Okay, so that's the intraday technical outlook of the dollar yen flipping to a intraday bearish bias. Now, turning our attention will be the Aussie dollar. So the Aussie dollar continues to remain trapped below the 166.86 short-term pivotal resistance that we highlighted before we go for our Deepavali break. Price action came down, sell off, hit the retest the minor swing low of this week. Okay, which is this level here, 65.40, before bouncing up in today's Asia session. So with that, I will still maintain, because price action on the hourly RSI continues to trade a lower higher over here. So for sure, this 66.86 is indeed a short-term pivotal resistance level. So I will still maintain this as my intraday bearish bias on the Aussie dollar. But first support level to watch will be 65.40, pardon me. I repeat again, still maintaining that intraday bearish bias using 66.86 as my short-term pivotal resistance. First support level to watch for today will be 65.40. Only a breakdown below 65.40 exposes 65.20, pardon me, 65.10, which is a cluster of Fibo extension level. And graphically, if you go back over here, is the 7th of August and 8th of August minor swing low. Only an hourly close above 66.86 will invalidate today's intraday bearish bias to see a mean reversion rebound at least in first step to revisit 66.15, which correspond to the 200-day moving average as well. Above it potentially sees 66.60, which is corresponding to the downward sloping 20-day moving average. All right, so that sum up the intraday technical outlook on the major dollar FX pair. So now turning our attention will be the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 continues to be rather trading with a whipsaw range over here. So with that, price action now has starts to broken below this minor descending trend line that I draw. Previously, yesterday, it tried to test, come break, and shape that bearish sell-off during the US session yesterday over here. So with that, potentially there could be some form of weakness coming back into the Hong Kong 33 index right now. So I'll be using that also the 20-day moving average starts to actually turn downwards as well. So with that, I'll be using the 20-day moving average resistance zone over here, 20,850 slash 21,050 as my short-term pivotal resistance level. So previously, before the Bali break, we actually have a neutrality stance on the Hong Kong 33. So with that, I will flip to a intraday bearish bias for the Hong Kong 33 using 20,850 slash 21,050 as my short-term pivotal resistance level. First near-term support level to watch for today on an intraday basis will be at this level called 20,150. Okay, which is yesterday's US session low over here during the US session low. So only a breakdown below 20,150 potentially exposes the medium term pivotal support zone at 19,790 slash 19,445. But we got to have a breakdown below 20,150 for today. And also this pivotal support zone is rather crucial because it also corresponds very closely to the rising 50-day moving average. Only a push up with an hourly breakout above 21,050 would invalidate today's intraday bearish bias to see the bulls gaining the upper hand, at least on the intraday basis, to expose the next near-term resistance level at 21,550. All right, so that's for the Hong Kong 33. Now, turning our attention will be the Japan 225. So the Japan 225, before we went for our break, we looked for a bullish bias below the 38,940. So price action on Wednesday during the European session time actually pierced up, hit the first resistance, but can't maintain that positive momentum during the US throughout the European session and US session on Wednesday. Then thereafter tumbled down and broke below the 20, 50, 200-day, and now attempting to also break below the 50-day moving average. So it seems to us that the Japan 225 now is still being trapped within this complex sideways range configuration since the low of 27th of September. All right, so it's been trapped in this kind of complex range configuration. So with that, the hourly RSI now attempting to actually so-called shape. There's this bullish divergence. Okay, that this bullish divergence is being flashed out. So potentially what you could see over here is that with the exit from the oversold region, so there could be a snapback rally for today, at least a minor snapback rally to retest the 20-day moving average. So if you were to actually do a Fibo retracement taken from the high of 30th of August, 30th of October, pardon me, all the way down to today's intraday low at this point in time. Okay, it closed to the 61.8% golden ratio as well. So with that, I'll be looking at because it's now coming to Friday. I'll be using this 38,940 here for that turning point for this potential mean reversion rebound. So as long as this 38,950 can't surpass to the upside in this potential mean reversion rebound scenario, there could be some form of further downside pressure reasserting itself at the 38,940 level. All right, around this level here. So we will still we will flip to an intraday bearish bias, looking up for the mean reversion rebound potentially to end at around 38,940. Then thereafter, there could be some form of bearish pressure reinserting itself back again on the Japan 225, exposing the next near-term support level at 37,780. Maximum potentially the lower limit of this complex range configuration over here, previously supported as well during that snap general election outcome at 37,395. However, if price action managed to have an hourly close above 38,940, then that would invalidate that so-called anticipated intraday bearish bias to see the continuation of that push up to revisit the upper limit of this complex range. The upper limit acquired at 39,558/680. Above it sees the maximum upper limit at 40,155/40,280. Okay, so that's for the Japan 225. Now, turn our attention will be the German 30. So German 30, still recall that previously there's this failure bullish breakout over here, almost hit the all-time high. Then after that, it tumbled downwards. So that's where we flipped to a intraday bearish bias on Wednesday before the Deepavali break. All the way, price action tumbled within our expectation and hit the support level at around 19,200, 19,100, 190. Then it actually inched down much lower at this point in time over here. So right now it's actually testing the 50-day moving average at this point in time. So with that, there could be some form of minor bounces heading into the European session thereafter. So I'll be using this 19,233 as my short-term pivotal resistance for today for these potential minor bounces to be kept. As long as it didn't have an hourly close above 19,233, we will still maintain that intraday bearish bias on the German 30 for today. Next near-term support level to watch will be at 18,960. Only an hourly close above 19,233 will negate today's intraday bearish bias to see the extension of the mean reversion rebound scenario taking shape to revisit the 20-day moving average, now confluencing with the next intermediate resistance zone of 19,230/19,370. And if you could do the Fibo retracement from the steep sell-off from 29th of October all the way down to yesterday's US session low, that also corresponds very closely to the 50% Fibo retracement as well. Okay. Now, with that, let us turn our attention to the US stock indices, starting the US Wall Street 30. So the US Wall Street 30 last Wednesday, on Wednesday before the Deepavali break, we flipped to an intraday bearish bias. Price action hit the support level at around 41,850 level and broke below the 50-day moving average, and also broke below the lower limit of this medium-term ascending channel that I drew from the low of 6th of September now in dotted turquoise grid. So with that, price action now is a bit mixed. We do have a bit of mixed element coming into play with the hourly RSI now shaping that bullish divergence. So with this mixed element on the US Wall Street 30, I will have a neutrality stance for today instead of keeping that continuation of the bearish stance that we have on Wednesday. So neutral between 42,140 and 41,560. So 41,560 is pretty key. This very clear congestion area here, previously resistance, now turns into a pullback support level. So neutral between 42,140 and 41,560. So only an hourly close below 41,560 will reinstate that bearish bias on the US Wall Street 30 to expose the next near-term support level in first step at 41,165, 41,000 figure level. All right, this next congestion area here of 10th of September and 12th of September. Okay, so that's for the US Wall Street 30. Now, turning our attention will be the Nasdaq 100. So the Nasdaq 100, still recall that previously we actually looking this as a failure bullish breakout above the upper limit of this bearish descending wedge, and indeed it was a failure bullish breakout because it tumbled all the way, broke below the 20-day moving average, broke below 20K, and also broke below the lower limit of this bearish descending wedge configuration and the lower limit of the medium-term ascending channel support that I drew from the low of 5th of August over here. So with that, there is no bullish divergence that is being seen on the hourly RSI. Okay, there's no bullish divergence. Of course, price action trade a lower low over here. But now the RSI has managed to exit from the oversold level. So potentially there could be some form of minor bounces taking shape. First minor bounce support resistance level to watch will be at 20,155, which is so the pullback line of the former bearish ascending wedge support now turns into a pullback resistance, and the major ascending channel support now turns into a pullback resistance at 20,155. So as long as this minor bounce didn't surpass our short-term pivotal resistance that I have for today, 20,306, which correspond to the 20-day moving average, I think as a resistance, and as well as the sell-off that taken shape from Wednesday all the way down to yesterday US session low, which is close to the 50% Fibo retracement. We will flip to an intraday bearish bias on the Nasdaq 100 using 20,306 as my short-term pivotal resistance level. Next near-term support level to watch will be the 50-day moving average at 19,810. Below it exposes 19,635, which is the minor swing low area of 2nd of October. Only hourly close above 20,306 will invalidate today's intraday bearish bias to see another choppy push up to revisit the 20,560 / 20,615 level again. Right, so that's for the Nasdaq 100. Now turning our attention to the commodities market over here. So let us kickstart the commodities market, starting with Gold XAU / USD. So Gold XAU / USD attempt to be a rather choppy movement. So it broke below the Titan short-term pivotal support level that we have at around this 550 level. Okay, then it broke down, hit the next support zone at 2728 / 715. Okay, almost very good. Then before shaping that recovery throughout yesterday's US session. All right, and what we could see over here is that the hourly RSI also has started to exit from the oversold level after hitting a rather gross extreme oversold level that was the most in the last 3 months or so. Right, this is the most in the last 3 months, and exit from it. So with that, right, given this rather kind of a deep oversold exit from the oversold region yesterday, seems that this movement here is rather like a capitulation of the bears, or a bit of panicking, but managed to survive at the next support level at 2728 / 2715, which is very important. This was tested 1 time, 2 times, 3 times. So with that, I'll be using because no point flipping to a bearish bias because it's very close to this next key short-term support at 2728 / 2715. So I'll be using this 2728 / 2715 instead as my pivotal support level. Still maintain that intraday bullish bias on Gold XAU / USD. First near-term resistance level it got to surpass is yesterday's breakdown point that kickstart this 2 bearish Marabuzu candlestick on the hourly basis, which is at 2774. Above 2774 potentially exposes the next near-term resistance level at 2,800, which is that Fibo extension cluster level, and the upper limit of this medium-term ascending channel that I drew from the low of 8th of August. However, a breakdown below this 2715 level, short-term, a breakdown below 2715 with an hourly close below it, that would invalidate today's intraday bullish bias to kind of see that extension of this minor corrective decline sequence to expose the next near-term support level at 2,684, followed by 2,667 next. Okay, so that's for Gold XAU / USD. Now, turn our attention will be lastly the West Texas crude oil. So let me share with you the West Texas crude oil daily chart. Yeah, so this is the daily chart. Very clearly, price action gap down on Monday. After that, we have a so-called lackluster Tuesday, and on Wednesday, price action, and Thursday it starts to push up again. So it can't break below this medium-term pivotal support level, which is the range configuration lower limit that is in place since 20th of March last year. Okay, this kind of we consider this as a descending triangle range. Descending triangle range. So it's still being trapped in this medium-term or some also not even the major, because it's about more than a year of major descending triangle range configuration that is in place since the low of 20th of March. Okay, so with that, if you look at the hourly chart over here, price action has managed to surpass the upper limit of our neutrality range that we have before we went for Deepavali break. So RSI now is at the overbought level. Yes, we were overbought, but during this overbought level, there is no bearish divergence. Price action continues to inch higher. So with that, yes, now it's trying to exit from the overbought. So there could be a chance of a minor pullback taking shape. So as long as this minor pullback didn't surpass below this breakout zone that was taking shape on Thursday at 6950 / 6885. So I'll be using this breakout zone here as my short-term pivotal support zone. So as long as this short-term pivotal support zone holds, potentially there could be a inch up to expose the next near-term resistance level at 72.25, followed by 73.15 level. Okay, which is correspond very closely to the 20-day and the 50-day moving average, I think, as a resistance level as well. However, only a breakdown below this 68.85, then potentially we will see a invalidation of this intraday bullish bias to see a choppy push down to revisit the major descending range support zone again at 67.55/67.10. Okay, so that sum up the intraday technical outlook on West Texas crude oil, and as well as the intraday technical outlook on the broad-based cross asset classes. So with that, now let us now have a view of what are the economic data to look out for today. So for today, key data will come in during the US session, but before that, let us take a look at the European session. What are the key data to look out for? So during the European session, nothing, pretty much quiet over here. Nothing important to highlight. So the action will come in the US session with the release of the non-farm payroll data at 8:30 p.m. Singapore time, and similarly at 8:30 p.m. Singapore time will be the unemployment rate. All right, so market participants now is expecting a slowdown in terms of the monthly jobs added. So only looking at 113k job added from previously of the 254k. So this is more likely due to the previously that hurricane disaster that hit some of the states in US. So unemployment rate continued to hold stable at 4.1%. That was the expectation. And thereafter will be a rather quiet US session. Then we come later at, okay, one more, not quite one more, my apologies, one more to highlight is the ISM manufacturing PMI data. So this one will come in at 10 p.m. Singapore time. So this is more survey based, and market participants will be looking at the ISM manufacturing employment subcomponent as well, that continues to sluggish below the 50 level mark. So that will come in at 10 p.m. Singapore time. All right, so with that, that sum up today's intraday today's we call it daily dose or market insights, pardon me. So I'm Kelvin here signing off, wishing you all a great and restful weekend ahead, and we shall speak again on Monday. Thank you.